In today's video, we're going to talk about choosing the best EMA setting for trading. The best setting is what a lot of people are looking for. So we're going to talk about that. And before we get started, if you just hit the subscribe button down below, that way you're always notified when we post up new videos, and make sure you give us a thumbs up so we can continue to keep on producing this content. First, if you don't know what the EMA is, the exponential moving average, it's just a type of moving average, and it places more weight on recent price to create a smoother and more responsive moving average. It's a pretty popular tool among traders who are looking for trends and also to identify potential reversals in price. But because they place more weight on recent prices, they can also be more volatile than other types of moving averages, giving you some false signals as well. So this means that choosing the right length is important for ensuring that you get an accurate picture of the market. So again, as I mentioned, the EMA is a moving average, right? That's giving more weight to the recent data. And this weighting is based on a pretty complex mathematical calculation, so the EMA responds more quickly as price changes. So when the data is trending upwards, the EMA is also going to trend up. When it's trending down, the EMA is going to trend down. So it's used to smooth out the data, and it can also be used to identify trends. And like I said, it's pretty popular. So how is it different? Now, there are a number of moving averages out there that are used by technical analysts, and each has its own advantage and its disadvantage. And the most common type that you'll hear about is probably the simple moving average, the SMA. That's simple. It just takes the average price over a specified period of time. That's it. However, it's often criticized for being slow to react to changes in price because it treats all the data the same. So the EMA addresses this issue by giving this recent data more importance. So as a result, some people think it's a more accurate reflection of current market conditions. Another advantage of it is it can be used to generate buy and sell signals when you look at some other technical indicators with it. For example, many traders will use an EMA crossover as a signal to enter or exit their trading position. And while the EMA does have some advantages over other types of averages, it's important to remember that no indicator is perfect. As with all tools you're going to use as a trader, it is important to use it in conjunction with other forms of analysis before you make any sort of trading decisions. So the juicy stuff, how do we get the best EMA length? Well, I'm going to break it to you right now. There is no right setting. There's no best setting, because the best length is generally going to depend on your trading goals, the time period of the chart you're using, and your trading style. As an example, shorter settings, they're better for identifying short-term trends. Longer period settings are better for identifying long-term trends. Some traders will even use multiple moving averages of different lengths on the same price chart to give them a more complete picture of the market. So the key is really just to experiment, find out what works best for you. And one way to do it is just look at historical data. See how the different lengths would have performed in different conditions. You could just also test them out in a demo account, see how they affect the profitability. But whatever you choose, the most important thing is take the time to find the length that fits your trading style and one that you can use consistently. But when it comes to the period and length, I'll give you 3 different period settings you should think about using. The 10 period, it's pretty popular in stocks. It's fast moving. Oftentimes it's used to read momentum. The 21 period, medium term, average, you can switch it with a 20 period. It's not going to really matter. It's good when it comes to riding an intermediate term trend. The 50 period, it's a long-term moving average. That's suited for identifying a longer-term direction. But look, don't get too bogged down in the exact setting. If you use an 18 period or a 22 period, it's not a whole lot different than just using a simple 20 period. Now, the 8 EMA and a 21 EMA, these are probably 2 of the more popular settings that are used. The 8 EMA is shorter term, 21 EMA, longer term. And you can use these 2 together to help identify trends and generate your signals. Now, one popular strategy that uses this combination is the moving average crossover. This strategy is based on the idea that when the 2 averages cross, it signals a change in trend. For example, if the 8 crosses above the 21 EMA, it could be a sign that the market's about to go up. On the opposite of that, if it crosses below the 21, it could be a sign the market is about to go down. But you want to use it with other indicators if you're going to use that crossover. For example, Even just using support and resistance levels is a lot better than just trading the crosses. So if the moving average crossover occurs at a support or a resistance level, it could be a strong signal that a trend is about to occur in the opposite direction. Some traders will enter a position when two averages cross, and they'll exit when they cross back. Others will use the average crossover as a signal to enter and exit when another technical indicator gives them a signal to do so. But my personal choice would be to use a crossover for direction and a pullback to the averages as a trade setup. And this technique is a lot more powerful if that pullback comes into an area of support or resistance. You just trade the reversal back in the direction of the trend. Again, I'm always going to say it. The important thing is to find a method that's going to work for you and that you're comfortable with and that you can do consistently. Now, when you use an EMA, there's a few things you got to keep in mind. First, they're not always accurate, right? You got to use them in conjunction with other indicators. Second, they're trend following, which means they're going to lag the market. As a result, it's important to use them with something else that can help you confirm the direction of the trend. Third, all moving averages are going to give you mixed trading signals during a range. So you want to learn the difference in price structure for a trading range and trending market. Knowing the difference is important. So on this chart here, you can see support and resistant areas, as well as a mixed trending structure pattern. You want to wait until price breaks from the range before you look for a trade entry. Finally, EMAs of different lengths are going to produce different results. So it's really important that you experiment with different settings to see what works best for you. I'm always going to repeat that. So to keep these things in mind, you could use EMAs to give you a potential, not a definite, but a potential edge in your trading approach. Obviously, you have to test it out. To wrap it up, there is no best setting. There's no perfect length. That best length is going to depend on you, your goals, and your style. If you day trade, hey, you might want to consider using a shorter average. Swing trading and investing, you're going to want to use longer ones. Just experiment with different lengths. Find what's working best for you, what you read the best. That's the bottom line. But again, remember, use the averages with something else, another indicator, including price, to confirm trends and to generate accurate trading signals. That's it. Wrap this up with a hit subscribe. We'll talk to you soon.